You're entering the future-ready CNBC-TV18 EBIX Cash Studio.
Well, markets ended Friday on a high with the benchmark indices outperforming the broader markets. 43 out of the 50 stocks ended higher. For the week, the Sensex, Nifty and the mid-cap indices ended in the green. Nifty Bank, though, closed in the red. It's been an underperformer. Hello and welcome to a fresh new edition of Taking Stock, the show where we review the week gone by, but more importantly, try and prepare you for the week ahead. I'm Prashant Nair. With me, my colleague, Ekta Batra. Hi, Ekta.
Hi, Prashant. Yes, absolutely. It was quite a roller coaster week in terms of the number of earnings we had to reckon with as well as cues. But nonetheless, all that and more in the next 30 odd minutes. Let's in fact tell you what we do have lined up on the show for you to assess the week gone by. We have with us Ashwini Agarwal, the co-founder and partner, Ashmore Investment Management India. And to prepare you for the next trading week, we have Rohit Srivastava, founder and strategist, IndiaCharts.com. In Corporate Voices, we have Ronojoy Datta, CEO of Indigo. We also bring you all the big market voices that we got through the week, from Saurabh Mukherjee of Marcellus Investment Managers, Arvind Sanger, Geosphere Capital Management, and Samir Arora, Helios Capital. Okay, well, those were all of the voices that we have lined up. But let's in fact tell you what exactly happened this week. The key indices, the Nifty was up around 1%. We had the mid-cap index, which was outperforming, so it was up around 1.5%. And the small-cap index also did quite well. It was up around 1.1%. Now, in terms of what stood out this time was that the US CPI inflation, which was the highest that we've seen all the way in 3 decades, that really hit sentiment midweek. But we had earnings which were top of mind the entire week today, because it was the last week really of the quarterly numbers. So in terms of a couple of newsmakers, you would have to say, from the frontline indices, and I'm not only talking about numbers here, but predominantly numbers. We had the likes of Tata Steel, Divi's, M&M, all of them reacting to numbers. But even something like an IndusInd Bank, which was in focus on account of news, it was the top loser on the Nifty, and Bajaj Auto, which lost out as well in trade. In terms of the broader markets, we had a lot of result reactions, and that's exactly what it is, from the likes of BHEL, Thermax, Pidilite, Berger Paints, Metropolis, Narayana. A lot of mixed reactions, you'd have to say, and even in terms of Alembic and Strides from the pharmaceutical space. It was a week where the FII sold for majority of the week, so that was definitely a negative. And obviously, new age companies were the flavor of this week as well, the likes of Nykaa with its listing, Paytm with subscription, and Zomato, which released its quarterly numbers. In fact, let's go across to Nigel, who's here to tell us about all of the movers and shakers this week. Nigel, over to you.
Well, the Nifty ended high with a gain of close to around 1% odd, but that was without any support coming from the Nifty Bank. But the two pillars of the market are the banks as well as IT. And IT stocks, well, they more than made up for what the Nifty Bank didn't do in the past week. The broader markets as well, they pretty much kept in step, ending with gains of around 1% to around 1.5%. From the Nifty gainers itself, Mahindra & Mahindra, that came out of the set of numbers. The street lacked the commentary as well. Stock ended high with a gain of around 7.5%. Bharti Airtel was part of the winners list. Tech Mahindra, they had an analyst made. The takeaways were quite positive out there. Throw in there Adani Ports as well. They did pretty well in the past week. Titan was expensive, continues to remain expensive, but they're gaining market share. So even at those multiples, it continues to see buying interest. In terms of losers, IndusInd Bank, they had a technical glitch. The management did give out a clarification, but the street still sold the stock. It was down close to around 7% for the week. Divi's Laboratory reacted to its numbers. At these valuations, select brokerages like Kotak were a little bit cautious as well. SBI did have a good reaction post its numbers, but now it's giving back some part of what it put on. And Tata Steel, the fear is the best in terms of margins for some of these ferrous companies are behind them. So that's why that stock as well did see some selling. From the broader markets as well, there were some losers. So BHEL, well, they cut down in terms of operating losses, but that stock as well did get sold into. Sun TV, valuation-wise, was cheap. It continues to remain cheap, but that stock, in fact, did end under some pressure. Remember, it came out with its set of numbers as well in the past week or so. JSPL from the ferrous space continues to see selling pressure, and the real estate stocks have did well, but a couple of those big winners, well, they gave back some part of what they did put on. But let's end it on a positive note. You had IEX, Muthoot Finance, that came out with its set of numbers and very, very strong commentary from here on. BEL, as well as Adani Enterprises. Well, that winds up the list of some of those winners from the broader markets.
Okay, Nigel, thank you very much. That's an exhaustive kind of list in terms of what moved this week and how much up and down. I'm going to take exactly 60 seconds to sort of lay out the local picture and the global picture, because, Friday's session came out of nowhere. We had that big 200-point move, which is in percentage terms a little over 1%. But the fact is that we closed at the upper end of this week's trading range, which is around the 18,100 zone. I mean, the week was spent between 17,850 and about 18,100 or so. The bigger range is, basically this 1,000-point range. The live high, which was 18,600, to the recent low, which was around 17,600. That is on the 29th of October. By the way, as of Friday's close, we are very close to the 50% retracement of this, 1,000-point drawdown that we've seen. 1,000 points was about, 4.5%, 5%. The question is this, though. Is this sustain? Will this sustain? And is the correction done? And we are, re-entering, like what we saw on Friday with large caps, a more bullish frame of mind. The question is clouded by global factors. The dollar is starting to move higher. On Thursday night, it basically broke above an important resistance level. There's a double resistance which the dollar index went through. There's a 200-day moving average which coincided there. If Friday's session confirms this breakout, you're basically looking at a move to 97 on the dollar index. Not exactly a very constructive thing for emerging markets, dollar moving higher. And the second thing is for US equities, Citigroup has an indicator called the Poles model. It's not a sentiment indicator. They look at quantitative data in the market itself, and that is now flashing red. It's hit a level of 16, which basically calls for a bit of a pullback. And so far, over the last 18 months, it's essentially been pretty reliable, even for smaller 3-4% kind of pullback. So we will see. Are we entering a bit of a risk-off phase? Will we enter a bit of a risk-off phase globally? I think that is the number one question, which will determine how things go here as well. Let's put some of these points to Ashwini Agarwal, co-founder and partner at Ashmore Investment Management, who's joining us. Ashwini, great to have you here. Thanks very much. I think I laid out the preamble. I'll just try to ask you, what do you think? Do you agree or not? Welcome on the show.
Thank you, Prashant. Thank you for having me here. Interesting. Today's rally was very, very exciting and unanticipated, at least for me personally, because the earnings season has been a little softer than the earnings season we've seen over the last 3 quarters or so. As you say, the global markets are looking a little stretched, and there are kind of warning bells going off here or there. The subscription data to some of the recent IPOs that closed this week was also not as energizing as one might have expected. So I was actually thinking that this patch of softness that we saw over the last couple of weeks would probably go on for a bit longer. So I was very surprised by the rally today. So it might have been short covering, it might have been some technical reasons, I can't say. And like you said, that I think the market is looking for direction. I don't think there is any conviction either on the upside or on the downside. The macro story in India is extremely compelling and strong. But there are headwinds in terms of valuations, in terms of earnings momentum, in terms of paper supply, in terms of global queues. So I think, we have to find a way out. We're kind of muddling along for the moment with no clear direction. That's at least my take.
Okay.
Not very helpful, I would admit.
All right. Well, one of the sectors which stood out this week was the Nifty IT sector. It was up around 3-odd%. It was fairly resilient. We had TechM, for example, which was up around 4-odd% post a brokerage meet as well. What is your sense in terms of incremental buying within that space?
IT has obviously done extremely well over the last 1 year. The demand conditions continue to be very robust. Businesses are doing very well, at least on the revenue front. They all continue to struggle with shortage of manpower, especially in a few areas, and wages are rising. So we are all kind of wondering what will do better than expectations. Will the revenue be strong enough and the operating leverage big enough to compensate for the kind of higher attrition and higher wage costs we are bound to see, or it's going to be the other way around. Valuations do not any longer give you the room for a disappointment. I mean, take pharma, for instance, right? This is one quarter after many quarters where pharma failed to live up to its expectations. The problems are all known. If you think about it, the overstocking in the US, raw material pressure prices, transportation costs, these are all known factors. Nothing was unknown. Similarly, in IT, we all know what the problem is. The problem is manpower, the problem is wage costs, valuations are high. So if you see a disappointing set of earnings, and by disappointments, I don't mean a large disappointment, even a small disappointment, but when the stock is trading at 40x or 45x, that's enough to take the stocks down. So yes, IT has done very well this week. Partly it's dollar, partly it's the fact that there is no clarity that anyone has. So earnings traction and earnings momentum is probably the safest place to be. And I think that's what's supporting IT services stocks for now.
Just one name, and I'll come to you, Ashwini, in the sector. And you're hesitant talking about individual stocks, but Interglobe Aviation, right? I mean, last couple of quarters, we've seen large net losses. The stock is held on. It's not as if it's corrected. But today, on Friday, Credit Suisse said that they may make a profit in the third quarter. The stock runs up 7.5%. So that's the kind of market we had on our hands on Friday. But the question for you is going to be where from here, Ashwini. But before that, let me bring in my colleague Sonia, who will tell us what Credit Suisse is saying, and we'll play out a soundbite from the Interglobe management as well. Sonia.
Well, thanks a lot for that. As you rightly pointed out, it's a 7% gain that you're seeing on Interglobe Aviation right now. Now, the stock has been surging ever since the management spoke to CNBC-TV18, where they said that things are definitely improving and on the mend. They are expecting to return to profitability very soon, and they said that the cash burn, the daily cash burn is going down for them, and corporate travel is also coming back, not just individual travel. Now, Credit Suisse released a note today where they have an outperform. They have a target price of 2,700 on Interglobe Aviation. They say that a profitable quarter is definitely in sight for the company. The recovery in the month of October and November was very strong. Remember, it was the 5th straight month of an improvement in passenger air traffic, and the yields have also picked up quite a bit. So now they say that the average passenger yields for Interglobe Aviation can rise to 4.5 rupees. There's also lower competition that Interglobe is facing. They continue to be the market leaders, and the load factors are expected to recover to 80% in quarter 3. They're also expecting a 15% compounded growth rate for the company over the next 3 to 4 years. So positive management commentary and a brokerage report of Credit Suisse where they have upped the target price as well as positive commentary there is something that's spurring the stock today.
Things are improving and improving rapidly, I would say. We went, as you know, the government allowed 100% capacity, and we've gone to about 95% and heading towards 100%. We are now most hopeful that the next target countries will be Saudi Arabia, Nepal, and Thailand. And if those markets also opened up, that'd be great. Balance sheet really took a battering, as you know, over the COVID period. And now we'd like to repair that balance sheet. So yes, we're still burning cash, but we have a sort of slight glimpse that profitability may not be too far off.
Assured profitability, Ashwini? Or you think, what do you make of it though? Yeah.
Okay, with the disclaimer that, we don't really comment on individual stocks. I think the entire reopen trade is a very interesting trade. And I call it a trade rather than an investment because I think there is a pent-up element to it. Whether it's travel, whether it's hotels, whether it's eating out, whether it's retail, you've seen a very strong traction in all these stocks of late, whether it's cinema houses, for instance. And obviously, all of us who've been kind of locked up inside our homes, unable to do much, unable to travel out, are itching to stretch our legs and to tickle our palates. So I think in the short run, you'll obviously see a very, very strong surge in revenues across all of these areas, and that's what is driving these stocks. The question is that, how does the competitive scenario unfold, especially in airlines? with the Air India Tata, acquisition pretty much around the corner. And as sectors open up and as travel picks up and as more and more flights come in, what happens to pricing? Pricing is pretty stiff right now. During the pandemic period, when number of flights were restricted, ticket prices went up. Initially, there were some caps and floors in place, but that's kind of forced a certain uptake in revenue parameters, as the Credit Suisse report that you referred to pointed out. And will this survive over a longer period of time is something that we have to see. But obviously, in the near term, there is going to be significant revenue and earnings traction for all reopened trades, purely because human nature will determine that people will go out and do what they've been missing for the last 2 years. That's really what it is.
Okay, all right. So that's on Interglobe Aviation and the aviation space as a whole. But it was really all about the new age companies this week, and it will continue to be in focus next week as well. Paytm and PB Fintech are set to list next week. Yash is here with all of the key highlights, such as the subscription details and the valuations. Yash.
Ekta, so it was all about Nykaa, which got a lot of excitement as far as the primary market this week is concerned, and going to the next week, PB Fintech and Paytm would continue that excitement. Both those companies are going to list on the exchanges next week, and there are a lot of expectations considering what we've seen in the current week. Paytm IPO size was about 18,300 crore, the largest ever for the Indian capital markets. For PB Fintech, it is about a 5,700 crore IPO which will be getting listed. As far as the listing day is concerned, of course, it will be a function of two things. One is the kind of subscription figures that we've seen for both these companies, and the second one is the valuations which they are demanding. Speaking about the subscription figures, Paytm managed to just scrape through on the last day of its subscription with a total subscription of about 1.89 times, whereas PB Fintech was a little better with a subscription of about 16.5 times which the IPO received. That will be one aspect which will decide the gains or the kind of listing that these both companies have. The second function would be as far as the valuations are concerned. Paytm is seeking valuations of about 50 times FY21 revenue, whereas PB Fintech is at 44 times FY22 estimated sales. So of course, it remains to be seen if these IPOs get anywhere close to the kind of Nykaa returns which Nykaa gave, and the investors really looking forward to that day.
Okay, all right, Ashwini, what are your thoughts? Would you be putting your money and your time and your mind space when it comes to these new age companies, and how would you choose actually?
Very interesting. I think the observation I'm going to make is no different from what several observers on your platform have made in the recent weeks. It's very exciting to see these businesses do so well, and hats off to all these promoters who've created these businesses, obviously met a lot of unmet needs and prospered. This is great for the Indian economy because it unlocks both risk capital and risk appetite, which bodes really well for long-term growth prospects for the economy. But when it comes to buying stocks, we have a little bit of a value bias, and the question I ask myself is that whichever one of these companies or new age companies that we look at, what are we paying upfront in terms of value, and how many years out are we willing to wait for returns to show up? All of these businesses will grow. I have no doubt in my mind, and some of these will be outstanding successes. But the risk that we are taking upfront as investors in buying these stocks today is that if you were to buy a basket of them, you'd probably have a bunch of losers and maybe few winners. The other way to put it is that the probability of success of making a reasonable return on your investment on a 10-year horizon of say 10 or 15% per year is reasonably low because your upfront investment is very high. Take the clock back to 2000. It's not that the IT stocks did not make you money from the highs of 2000. They did. But you had to hold on for 10, 15 years before you actually made money. And there were a lot of fatalities along the way as well. So we are in the same kind of a situation. Great opportunity, a great long-term runway to growth. Obviously, there will be some successful outcomes, but probably we are paying too much upfront. That's my take.
Got it. Ashwini, it's always a pleasure. Thank you very much for joining us, and insightful conversation with you as always here on the show on CNBC-TV18. Thanks very much for that. We'll take a very quick break here. We are going to come back. We'll talk technicals. Rohit Srivastava is going to be running us through what he makes of the market. Last time he was on the program a few days ago, he said, well, we are headed back to 18,600, 18,800 kind of levels. The worst is behind. So we'll do a check with him on the other side.
Welcome back. Well, let's get talking to a technical analyst. Rohit Srivastava, founder and strategist, IndiaCharts.com, joins in with his view for the technicals next week. Rohit, what did you make of the markets this week? There are higher highs and lower lows being made for the markets, and not to mention the sectors that you would be bullish on going into next week's trading session.
So the first thing I think to highlight is the index itself has managed to cross back above the 20-day moving average. I think the last time it broke it was on the 28th of October. And so that's really good news that we've managed to, do that after, several days of, trying to consolidate below the averages. So that's, and if you look at the entire move from the 29th of October, we've actually made higher highs and higher lows. So we bottomed at, say, 17,613. Then we went back to 17,757. And yesterday we were at 17,798. So this whole pattern of higher highs and higher lows is essentially a sign of an upward trend. So we'll maintain that the Nifty is heading higher. And now that we've crossed the 20 DMA, I think the next benchmark would be to retest the high at 18,600 and possibly maybe surpass that as well. So that's what we're going to be looking for.
You're saying that the dollar is in the last stages of a counter trend move, Rohit? I mean, there's a lot of talk that the dollar is breaking out, heading higher, maybe 97. Your view?
So I don't think it's going to be a runaway move. And if you simply look at it, the first 9 months, the dollar was falling from March 2020 into Jan. And during that, it had a significant decline. Now, if you look at the last 9 months, it is trying to make a comeback, and it has retraced only 38% of the entire fall, not even 50%. And so this is a weak rally to me. Elliott wave guys, we look at it as a counter trend corrective in structure. It's just taking a lot of time because, we've made one attempt at 92, then we made an attempt at 93, then we fell off, then now you're making an attempt at 94, 95. I don't think we are really going to run up. It's going to, somewhere it's going to finally stall and turn over is what I think. And if you actually look at the cross-currency positioning also, which is not just the dollar, but multiple, currencies, how they are positioned against the dollar, at large, people they have the longest position against the dollar on the long side. So positioning is also that everybody is long, and you are sort of at a 38% retracement. So my sense is it's just a waiting game for the thing to roll over, where your long positions start to unwind, and the dollar starts another meaningful wave on the downside, which will last for maybe another 6 to 8 months.
Okay, what about sectors?
So, while the dollar is still doing that, we are not seeing so much strength in metals, but we are seeing most sectors participate. If we just look at the last 5 days, we've seen capital goods do well, IT do well, auto do well, and possibly energy do well. So, my sense is this will remain a broad-based move. We are seeing, in fact, in the cash market, we've seen days of strong breadth where 2,000 stocks have gone up. So there's not going to be this is not a place where you focus only on one sector. Everybody can take their pick of what they like, but in a sense, everything is participating. So it's a sign of a bull market. Doesn't look like it's over because we haven't really broken any meaningful levels, and you can make your pick across these sectors and focus on the upside. Okay,
look up, don't look down. Markets essentially headed higher. Rohit is maintaining that view. Thanks very much, Rohit, for joining us here on another edition of Taking Stock. Thank you for your thoughts. Well, from all of us here, Ekta, me and the team, it's goodbye. Thanks very much for watching. There is more coming up on the other side.